Hi everyone, shout out with another video, doing something I haven't done for a while, and it's looking at a famous investor's portfolio. It's 13F season right now. 13F reports for the end of 2021 have been released, so I want to look at Michael Burry, obviously a very well-respected investor, famous for his incredible moves during the 2008 financial crisis, as shown in The Big Short. He's frequently in the news talking about market crashes, major bubbles, and is typically a classic value investor. His company, Scion Asset Management, reported to 13F last week. I thought I'd dive into it, as the moves of the most famous investors are always an interesting insight. I think Michael Burry, while I'm not always a fan of his repeated talks of market crashes, I think eventually you're going to be right if you predict a market crash every month. I do value his opinion. So this 13F report effectively covers up to the end of 2021, so the fourth quarter essentially. Most recent quarter Burry did quite well. Market value of the fund is just under $75 million. Prior market value is $41.7 million. There's a couple of new purchases. Very interestingly, he's came down massively because he's predicted a market crash. It's now only 6 stocks, US stocks in the portfolio. 13F filings don't include options. Also doesn't include foreign stocks. For example, he has a position in Imperial Brands, a UK cigarettes company. But these are perhaps the most important positions, these 6 stocks in my opinion. So obviously just as interesting as the buys are the sells. Some really interesting sells here in his top 10 positions. Previously 24.8% of his portfolio was Lockheed Martin. He sold all of that and he only owned that for a very short period of time in Q3 2021. Burley for a game. CVS again, that he'd owned for about a year. He sold completely out of that. That was 40.68% of his portfolio. Obviously, Burry is bearish on the outlook of the markets, as he often is, and as mentioned recently. This small, concentrated portfolio indicate he doesn't have that many companies he believes with good value right now. Spoiler alert, they all trade on very low price to earnings. They're classic value investments. I mean, Lockheed Martin's trading on a price to earnings right now of about 10. CVS, not much more than that. And both of these, they were too much for him, essentially. So he's gone for really defensive, low price to earnings, inflation-resistant businesses that I'm going to talk about in a bit more depth now. So first up, the largest position in the portfolio, around 25%, and the largest company at just shy of $150 billion market cap is pharmaceutical giant Bristol Myers Squibb. Company that I'm actually quite a fan of. Haven't done a deep dive in it recently, but it is a company that I'm definitely a fan of. Has a diverse portfolio with a strong pipeline of therapeutics, strong year-over-year revenue growth across many of these therapeutics. All of this is at a reasonable valuation, 21 times trailing earnings, 8.7 times forward earnings, price to free cash flow just 10. Very cheap for the industry, and pharma is not an industry that is trading at huge multiples right now, and very, very, very cheap for Bristol Myers Squibb's historical valuations. Total full year sales, $46.4 billion, up 9% versus the previous year. Only 2 of those therapeutics that were on that list actually went down, Sprycel and Abraxane, and they were just down small single digits. So some of those therapeutics, Eliquis, particularly up 17% now with $10.8 billion in net sales and only increasing. This is all as well with a 3.2% dividend yield, an okay balance sheet. They took on quite a bit of debt with the acquisition of Celgene, but that gives them a wider portfolio and some growth. This looks good to me at this price. With that forward price to earnings of about 8 or 9, Bristol Myers Squibb is clearly far below the S&P 500 average, and is clearly discounted because people don't believe in the future growth of the company. The future for Bristol Myers Squibb actually looks pretty strong. Continued low to mid single digit growth, compound annual growth rate until 2025, and then the new pipeline should kick in, increasing growth from the new product portfolio, and advancing this pipeline they predict continued growth for the rest of this decade. Not particularly strong, not particularly weak. They hope to increase their optionality here. But this is pretty good from a company that pays a 3% dividend yield, is a mature business, $150 billion company, just increasing at low to mid single digits, 5, 6, 7%. That will be good enough for this company to perhaps be a market beater over the long term at such a low valuation. Next up, at just shy of 23% of the portfolio, is Fidelity National Financial. Not really a company that I follow, really. Kind of goes under the radar. I'm not aware of many people who follow this on YouTube or in the financial space at all. Fortune 500 company, so it's not small. Provides title insurance and settlement services, mainly to the real estate and mortgage industries. $13 billion company with 3.77% dividend yield today. Trading at just 5 times trailing earnings, 7.5 times forward earnings. Revenue has been growing solidly since 2015. Before that, it was a bit sketchy, but it's been growing solidly since 2015. as a most recent filing, is about $11 billion. This looks okay here. Clearly, Burry knows more than I do, and I'd have to do a lot more deep diving before I could say definitively if this is a buy for me or a sell or a hold or whatever. But this is a clear value play, extremely low multiples, just 4.27 times trailing free cash flow, 5 times trailing earnings, 7 times 4p earnings. This is a very clear value play in a relatively stable business in a strong real estate and mortgage market. Third on the list, General Dynamics. A defensive company, literally, it's a defence and aerospace manufacturer, highly diversified. They own Gulfstream jets, make all sorts of defence equipment such as the M1 Abrams tank and Columbia-class nuclear submarines for the US military. A $60 billion company, again, relatively low multiples, not insanely low for the industry, and actually not that good for General Dynamics history, but an 18 times forward earnings is still far below the S&P 500 averages at the minute. It's a $60 billion company. Good dividend yield at 2.2%, with some future growth that is definitely possible here. $38 billion in revenues is the most recent quarter. The company's most recent financial performance did not knock out the park by any means. The signs are okay here. 1.4% revenue growth from 2020, 0.7% operating earnings growth, 2.8% net earnings, 5% EPS diluted earnings up. The Gulfstream business segment is still struggling from the pandemic. There's not really been much demand for private jets, obviously. Even with that weakness, the numbers are still above 2020. Strong free cash flow, good earning numbers. Everything looks okay, a good base here to be moving forward, as defence spending will surely be moving up with the current situation with global geopolitics, looking at the Ukraine in particular. So there's definitely scope for General Dynamics to increase here. Next up is perhaps the most interesting company on the list. Not a well-known name, and definitely the odd man out here. AEA, Bridges Impact Corporation, ticker symbol IMPX. It's a SPAC. Again, certainly strange for Burry. Massive odd man out here. Shows he must have a lot of conviction to even keep this. It's a new buy. Quite a large allocation for a SPAC of this kind. 13% of the portfolio. Not good performance. Pretty much flat for the last year or so, since November 2020 when it had a big spike. Doesn't strike me as a typical Burry value investment, so I'm not really sure what's going on here. The SPAC is currently valued $500 million. Crucially, it's going to merge, apparently, with Harley-Davidson electric vehicles segment. This electric motorcycle company, known as Livewire, spun out of Harley-Davidson and will be going public as part of AEA Bridges. It's going to be approximately valued at $1.77 billion as of this announcement, according to Reuters. This is really interesting to me. The Harley brand is very powerful in the motorcycle industry. If electric motorcycles catch on, as they should, because this is the way the world is moving towards electric vehicles, could be a very good investment at just $1.77 billion when you look at the size of Harley-Davidson, which is roughly 10 times that, I think, right now. Maybe not that much. I think it might be about $10 or $12 billion. This is very interesting, though, because SPACs, I'm sure Burry will have some very interesting comments on the SPAC bubble that happened in early 2021. So, very interested to hear what you'd think of this. It's just a strange investment. I'm not really sure where this comes from. And quite a large allocation at 13% of the portfolio for such a risky investment, in my opinion. The last two are very similar and classic Burry investments, so I'm going to group them together. Geo Group is a real estate investment trust, or a REIT, that invests mainly in the prison sector, and CoreCivic owns and manages private prisons. This is yet another example of Burry's bearishness on the wider market, in my opinion. These are true all-weather stocks, insulated from inflation, not likely to lose business. People will still get sent to prison in recessions, of course. Both trading at low multiples. Price to free cash flow of 2.5 for Geo Group and 3.9 for CoreCivic. Both very low multiples. Price to FFO of just 2.5 again for Geo Group. Trailing PE of 5.88. Exceptionally low for the industry. Exceptionally low for Geo Group's history. Significant discount to the wider market for both companies. This is a classic Burry safe value play and the type of thing I would be expecting. Interestingly, Burry reduced his holding in Geo Group significantly down to 8.85% of the portfolio from 20% and increased his holding in CoreCivic by 143,000 shares, which was roughly a 1% increase in the portfolio. All these investments signal one thing to me, that Burry is very bearish on the wider market, and that these are classic all-weather stocks that are not going to do much in a recession, not going to do much in an inflationary environment, provide low single to mid-digit returns, maybe slightly negative, but be better than the growth stocks that are falling from the sky at the minute. Classic Michael Burry, classic deep value plays, not particularly my bag, it's just not something I would normally invest in. General Dynamics and Bristol Myers Squibb are the pitch to the bunch here. I like Bristol Myers Squibb I think it's a good company. It's a company that I've been looking to analyse in more detail because I've been looking at some pharma companies recently. I've done some videos on AbbVie and Pfizer. And General Dynamics is a company that I've looked at before, previously been a shareholder of Lockheed Martin. And I think General Dynamics is a good company, but the stock price movements have been pretty weak recently. So I'm interested to see how the Gulfstream business recovers. And I might do a deeper dive on it in the future because I think it's an interesting company. But for now, it's just sitting on my watch list. That being said, who am I to criticise Michael Burry's investments? He's obviously a very famous investor and very good at it. These companies, for the most part, are just not for me. I think it's a strange decision to sell Lockheed Martin right now. I think that's just a really strong company with a really good dividend track record. I think it's a very defensive company, and clearly the most recent price from when he sold has proved that. Again, who am I to criticise Michael Burry? He's obviously a very famous investor for a reason. With all that being said, none of this is financial advice. If you want some financial advice, you should talk to a registered financial advisor. And of course, do your own stock research. Comment down below to tell me what you think. And importantly, like and subscribe if you're enjoying the content. I'll see you again.